Imagine this: three friends, Ria, Kabir, and Dave, launch a handmade soap business. Ria puts in rupees 3 lakhs, Kabir invests 2 lakhs, and Dave contributes 1 lakh. They agree to share profits in proportion to their investment. But over time, they add more capital, make withdrawals, and split earnings. So how do they track each partner's exact share? That's where capital accounts come in. They're not just records, they're the foundation for financial fairness in a partnership. In this video, we'll explore how capital accounts are maintained, the methods used, and why they matter for every business run by more than one mind. So, what exactly is a capital account? It's a detailed record of everything a partner brings to or takes from the business: initial investment, extra capital, drawings, interest, salaries, and their share of profit or loss. Think of it like a financial fingerprint, unique to each partner. Just like a bank statement shows your personal balance, the capital account shows your position in the partnership. It ensures transparency, avoids disputes, and keeps each partner's stake accurate and updated year after year. Now that we know what a capital account is, let's explore how it's maintained. There are two main methods. Let's break them down. 1. Fixed capital method. In this method, the capital account stays unchanged unless the partner adds or withdraws capital. All other transactions, like profit share, drawings, interest, or salary, go into a separate current account. So, each partner has one capital account, one current account. For example, Ria invests rupees 3 lakhs and earns 30,000 profit. Her capital stays 3 lakhs while 30,000 goes to her current account. To fluctuating capital method, this one's simpler, just one account per partner. All entries, profits, drawings, salary, interest are recorded directly in the capital account. Because these amounts vary, the balance fluctuates every year. Now let's take a closer look at how these capital accounts are structured under each method. Fixed capital method. You'll work with two separate ledgers per partner: one capital account, credit, when capital is introduced; debit, when capital is permanently withdrawn; to current account, debit, for drawings and interest on drawings; credit, for profit share, interest on capital, salary, or commission. This method keeps things organized, especially when capital changes are rare. Fluctuating capital method. Here, everything goes into one single account: capital account, credit, opening balance, profit share, interest, salary; debit, drawings, interest on drawings, and share of loss. It's more dynamic, ideal when partners frequently make changes. It also gives you a complete financial snapshot in one place, though the balance keeps shifting year to year. Let's simplify it. Fixed capital method is like having two wallets. One holds your main investment, that's the capital. The other tracks your daily ins and outs, your current account. Fluctuating capital method. That's like using one wallet for everything: savings, earnings, and expenses, all in one place. Different businesses prefer different systems depending on whether their capital stays steady or changes often. So, which method should you use? Well, there's no universal winner, just what suits your partnership best. Go for the fixed capital method if capital rarely changes and you want a clear separation between long-term investment and everyday transactions. Choose the fluctuating method if partners often change their capital, or you prefer the simplicity of tracking everything in one account. And here's a quick exam tip. If the question doesn't specify, always use the fluctuating method. Let's look at how everyday partnership transactions are recorded: capital introduced, credited to the capital account. Drawings debited from the capital account or current account depending on the method. Interest on capital credited. Interest on drawings debited. Share of profit credited after it's allocated through the profit and loss appropriation account. Knowing where each entry goes isn't just important, it's what keeps your books accurate and your partnership fair. Here's a quick recap. Capital accounts reflect each partner's financial stake. You can maintain them using the fixed or fluctuating method. Choose the method that suits your business and always follow your partnership deed. And if there's no deed, the Indian Partnership Act steps in. Up next, we'll walk you through how to actually prepare these accounts using formats, journal entries, and real examples. Don't miss it.